Hello, everyone, and welcome to LPL Market Signals. Jeff Buchbinder here, your host for this week, with a special guest. I am pleased to be joined by Angelo Zino from CFRA Research. He is the head of technology research over at CFRA. So, Angelo, thanks for joining today. Looking forward to talking tech with you.
Great. Thanks for having me, Jeff, and hi, everybody.
Yeah, I think CFRA is a really good fit for our conversation today. CFRA is an independent research shop, and certainly LPL prides itself on its independence. So, love to get the straight talk from firms like CFRA, very popular partner. Many of you know them. In fact, the most popular partner for LPL advisors to get fundamental equity research to supplement the equity research work that LPL does. So really, really appreciate the long-term relationship. In fact, I'm pretty sure that CFRA was a trusted partner of LPL before I started at the firm, and I have been with LPL for 23 years. So we go way back. So thanks, Angelo, for agreeing to do this. Let's get into the conversation and let's talk tech. I've got a few questions here for you. So I think we have to start with the hyperscalers coming off of earnings season. So my question for you on that is will the AI spend pay off? And what gives you the confidence that it will, if that's your answer, that it will?
Yeah, so Jeff, and that's a good question. And I think the hyperscalers are probably a good place to start off, really, as they're probably the best indicator of whether or not AI spend will and is paying off. And clearly, they are the biggest capex spenders on the planet in terms of this AI spend at this point in time. So, in our view, I think the way that it's the best answer to this is that AI spend will eventually pay off. It'll be dependent on the demand environment in terms of how long some of this aggressive spend takes to really pay off. But in the same aspect of all this, what I would also say is these hyperscalers are realizing significant revenue at this point in time. It is translating to really high cash flow from operations. And ultimately, it's allowing them to continue to spend at this aggressive pace, which we think will be sustained here for at least the next 2 to 3 years. Now, when we think about, kind of how this spend is really taking place at this point in time, there's probably about kind of a 65% split between what I would call your servers and everything that goes into the servers. So that would be your chips, your networking, the memory, all that kind of stuff. And then the other, 35-40% right now goes into the data center side of things. Now, when you start thinking of in terms of building the data centers, right, the concrete and everything that's needed on that side of things, and I define that aspect of it, that 35-40%, in terms of sunk costs and high upfront costs initially, but ultimately the life of those data centers are significant in nature. In fact, Microsoft just extended it, I think, from 15 to 25 years. Companies like Amazon even have longer times on them, call it 30 years or so. So, you're investing heavily on that side right now. That's not necessarily going to take up 35 to 40% of the pie here, 3, 5, 10 years down the road. So overall, over time, you're going to kind of see this bend, and you're going to see, just a real good inflection in terms of higher free cash flow over time. But for the time being, it makes all the sense in the world to invest heavily on the data centers. And I'd say, more importantly, on the server side of things, which is more near-term cost oriented. That's where you want to spend more aggressively because servers equal revenue in many respects. So, but ultimately, when we think about all this early days in terms of the drivers as we inflect to more of an AI inferencing world. So if you think what's going to drive us, into the AI inferencing world, there's 3 kind of key drivers. One, it's the number of users, and I'd say that's very early days at this point in time. You've only got about 1 billion users on platforms like Gemini, on ChatGPT, and what have you. We think over the next couple of years, you're going to be talking about potentially 5 billion users so on these platforms. The frequency per use also extremely important. That's the second driver. So as you kind of get more of these users, even the existing users plus these new users are going to use these platforms a lot more frequently in nature. Not to mention, as we kind of push more to an enterprise driven world. If you look over the last couple of years, most of the demand for AI has been more consumer driven, has been adopted by the consumer, not as much so by the enterprise space. What's happening in 26 is definitely more enterprise driven in terms of the growth. And then the third driver is the compute per use. So AI agents take up as much as 100x more compute capacity than some of the more traditional use cases like Gen AI, for instance, or even some of these basic reasoning AI models that we saw just 12, 18 months ago. So all those factors are going to be huge contributors in terms of sustaining this demand and actually increasing it. And then when you kind of look at the cloud growth numbers that we just saw, what the street wanted to see was good cloud figures for Q2. We saw it across the board in terms of Google growing north of 80% year over year. You saw Microsoft at 43%. Street was looking at 40%. And then, of course, you saw a really nice acceleration out of Amazon in terms of getting up to the mid 30s. And when you look at the guidance here for Q3, these companies are also pointing to an acceleration. So all that new capacity that's coming on is getting completely absorbed by the enterprise space, and that is really a great indication that that AI spend at this point in time is starting to pay itself off.
Yeah, great points, Angelo. I've certainly been impressed with the cloud growth. Some of these companies are able to justify these big spending numbers pretty quickly. I know you've been looking at consensus expectations for just how big the spend will be. I just saw updated numbers this morning, actually. Over $1 trillion for the next 4 years. Is that possible? Or do you think those expectations are too high?
Yeah, I mean, when we actually think about the actual CapEx spend here, and we have, we actually look outside of just kind of the big four. We look at the big four, if you include Meta, along with the three big cloud providers, on top of some of these tier two players, the Oracles, the Neo clouds of the world, right? Some of these China providers as well. Our view is essentially CapEx spend this year will double year over year versus last year, which is absolutely phenomenal. But that's an indication of all these companies essentially blowing out all their free cash flow to invest aggressively in CapEx. As we go into 2027, we are looking for a deceleration in terms of the growth. We're looking at about 25 to 30% growth. That does get you, about to, let's call it a $1.7 trillion CapEx environment next year in terms of all the CapEx spend. If you're looking at just the four big ones, they'll get to $1 trillion on their own. They'll represent about 65% of the total spend out there. And we do think there's a realistic probability as you kind of exit the decade, we're going towards, let's call it a $3 trillion annual spend environment, which is actually something that Jensen Huang had predicted, 2 or 3 years ago. And it seems far-fetched in nature at that time. It no longer seems that far-fetched if you kind of start thinking about some of the drivers. It is going to be more of a timing thing in terms of whether or not some of these some of the demand indicators really play itself out. I'd say the biggest inflection that we do need to see is the shift to more of a physical AI world, right? It's, do we see more of these factories? Do we see, some of these automotive companies out there really inflect and start going fully autonomous in nature inside their factories and start building these AI factories, which then kind of, require you to continue to need more and more of these data centers. So that's going to be a big indicator and inflection in all this. But at this point in time, yeah, I mean, I think there's no reason to think that we're not going to continue to see more growth in terms of the CapEx spend here over the next 2 to 3 years. But it's going to decelerate in nature. And I would also say expect some potential casualties out there. And I think we have to be very mindful in what the financing environment looks like, right? Will companies be able to continue to tap equity markets and also debt markets? And I'm not necessarily worried about those hyperscalers. Where I'm a little bit more worried about clearly are those tier two players, the Oracles, some of the Neo clouds out there, which could see some bumpiness along the way here.
Yeah, sure. There'll be winners and losers as there
Yeah.
are in any technology revolution, and this is certainly one of the biggest ones we've seen in our lifetimes. So thanks for that, Angela. I know a lot of our listeners are just wondering, well, should we still hold tech, right? Or should we potentially be overweight tech? And so with that question, I really want to turn to valuations because it's clear that the growth is there. I know you highlighted one of the risks at least, which is, will the equity and credit markets help these companies fund these build outs, which are just massive. But how about valuations? I mean, do you see, whether it's semi software, networking equipment, whatever it is, do you see the valuations as reasonable enough that they are providing investors with a little bit of a cushion if some of this spending ends up being wasteful?
Yeah, no, and that's a great question too. So, the way I kind of look at this market today is, listen, nobody knows what things are going to look like in 9, 12 months, 24 months from now, whether or not some of this stuff can be sustained. And the big reason for that is we have a good idea of what the supply growth is, what the supply growth could look like. We have no idea what the demand side is going to look like because we're in uncharted territory. What I would say is what you want the market to do is to continue to act in a rational way, which we think they are. You look at when valuations peaked last year, it was October of last year, on a forward basis, you were looking at the S&P 500 tech sector trading about 32, 33 times. It was essentially at a 20-year high, kind of double topped in many respects from what you saw in June of 2024. So that's kind of your limit, your upward band, let's call it, in terms of valuations. If you look at it today on a forward basis, tra- uh, trading closer to 23 times on a forward basis. But I think more importantly, we're analysts, so we typically look ahead. We're looking at valuations already on a 2028 basis because as you get towards the end of 26 and to early 27, the street is very forward looking in terms of valuation. So that 16 multiple or so in terms of um, the tech sector is extremely enticing if you just look at it on a valuation perspective. Now, I think it's important to kind of look at how the sector is constituted at this point in time. Overall, we continue to have a positive fundamental outlook for the tech sector. And again, it's because the earnings growth is there and the valuations, at least at this point in time, is discounting a lot of the concern and potential risks that are ahead. It's not probably completely dismissing it because things could get ugly really quick, but it is discounting some of it, which is very different than what we saw, let's call it in 1999 and 2000, where valuations kind of ran up along with fundamentals. So this is actually doing the opposite. It's actually trying to find a peak and discounting those peak earnings. When you kind of look, sub overall tech sector, we kind of break it down into three components. We look at it at semiconductors, then we look at hardware, and then we look at software. I would say on the semiconductor side of things, again, we continue to have a positive outlook more because of the earnings growth trajectory. And also when you look at valuations, you look at the three biggest components within the tech sector of the semiconductor industry. It's NVIDIA, it is Broadcom, and it is Micron. NVIDIA about 13 times our 28 estimate, Broadcom about 15 times, and then you look at Micron about 4 to 5 times. Those are typically what you would see in what I would call peak environment, peak earnings environment. And if we can kind of continue to see a sustained higher spend environment, let's call it to 29 and 30, you're going to continue to see higher prices for the semiconductor industry. As long as, and it's probably not going to be dictated by earnings anymore. It's going to be dictated on the sustainability of this, the spend. So I think what investors are going to look more at is some of the derivative factors, right? It's going to be the AI monetization stories from the cloud companies, as well as how the spending environment from the enterprise space overall. So that's what's going to dictate whether or not these chip stocks go higher in nature. But overall, the earnings is there, and the valuations are at this point in time acting very rational in nature. I would say, as you kind of very similar on the hardware side of things. Hardware is more concentrated with Apple, obviously, but and we're big believers of the whole kind of AI at the edge phenomenon. But also when you kind of think about some of the other players out there, I'd say more along the lines of the Dells and what have you, the server providers. Again, the risk reward looks, fairly. It looks okay. I think on the software side, it's a bit mixed in nature. I'd say we're more positive on the infrastructure side, more neutral on the SaaS side. So on the infrastructure side, think about cybersecurity. Again, think about some of those cloud providers with Microsoft in there. Think about the Palantirs of the world. That area of the world. I'd say there is the data infrastructure providers, right? So examples would include the likes of a Datadog and what have you. I think there's very kind of real good visibility in terms of the long-term trajectory of those trends here, looking at over the next couple of years. The SaaS space is going to be, there's going to be a lot more bumpy in nature. You're not going to be able to prove, I'd say, from a high level perspective, that these SaaS providers won't necessarily see some of their business prospects erode over the next couple of years. Because if we're moving towards a more consumption oriented type of world, where enterprises are creating more of their own capabilities in house and kind of renting out this compute capacity, the money's got to come from somewhere. It could potentially come on the SaaS side. It could potentially also mean lower headcount from across the enterprise space as well. So which also indirectly or will directly impact the fundamentals on the SaaS side. So I'd say you kind of look at different aspects of the tech sector, and the risk reward is very different in nature. But what we do like, and why we continue to have a positive fundamental outlook overall for the sector, is because unlike what we've seen in potentially other cycles where we've kind of gotten this irrational exuberance, that's not necessarily happening in this period of time. And a lot of the potential concerns out there as far as the AI build goes, we do think is at least discounting a good amount of those risks.
Yeah, you kind of touched on a question I was going to ask you a little bit later about the AI disruption. I completely agree that you want the mission critical software. You want the software you can't really live without. You want to be sort of a layer below the SaaS layer, or the application layer. On that note, though, I wanted to ask you. I mean, how hard you talk to IT managers? How hard is it to replace software with AI? I mean, because I've heard all different things, and some tech companies are obviously ahead of the curve, right? In sort of
Yep.
building their own or vibe coding their own applications, but your typical company that's not tech, how long is it going to take for these companies to figure out what they're going to be able to vibe code and then to actually embed that into their workflows?
Yeah, I mean, I think it depends, right? And one, it depends on the industry. I think there are some financial institutions, from what I've seen, that have moved a lot faster than others out there. Some of it may also be, the how they kind of manage their budgets at this point in time. But one, you kind of have to look at all these at this point in time when you think about just the overall SaaS environment, and the different type of companies that are out there. Listen, we're shifting away from we're going towards this structured to unstructured world. In many respects, I almost kind of think about, other type of disruptions we've seen across the tech space over the last 20 years. I think kind of the whole, the shift to this mobility world, and, the impact it had when Apple kind of did what they did back in 2007, creating the iPhone, but more importantly, what they did when they created the iPhone, the impact from the App Store that they created, and what that did to other companies out there. Think about the Research and Motions or BlackBerries of the world, what have you, where people thought, having a massive install base was good enough, where where that company was going to be just fine, and ultimately we realized how quick technology changes, and how quick and how it erodes certain businesses that don't kind of keep up with the times. And I think in this environment, as we kind of again move towards this structured to unstructured world, there are going to be certain type of businesses. I mean, think if you're a content creator out there, where there are clearly being a ton of There are a ton of use cases that are being created, a ton of competitive offerings. Not to mention, it's probably also easier to create some of those replicate some of that stuff in house as well. So this isn't going to be, I think, on the software side, as in the pie gets a whole lot bigger and everybody wins for a couple of years, like we're seeing on the semi side in some respects. It's going to be along the lines of, there's going to be greater opportunities, especially as more compute capacity comes out there. But the companies that are moving to a consumption-driven world that have real good capabilities and can offer that manage the data and then kind of offer new use cases of value to that enterprise space will win. And then others that kind of keep chugging along and maybe they don't manage the data out there. It's going to be a little bit harder for them. But as far as budgets are concerned, listen, if you don't have an offering out there that's going to increase the revenue of enterprise X by 10-15%, that enterprise company is going to probably have to find ways to increase their IT budgets while more on the compute side, and find a way to maybe adjust some of the spend in other things that they do. It's probably going to come on the SaaS side of things, potentially again come from rationalizing headcount as well. So, but that said, I think there are a good amount of winners, especially some of the bigger software companies out there. I think they're going to find some great use cases and be able to they're going to use AI to be able to empower themselves. I would say it might be a little bit different on the services side of things. So think about some of your IT consulting companies, your IBMs, your Accentures of the world, where it might be a little bit tougher for them to kind of start realizing this the benefit. They may have kind of more of a direct attack in terms of the AI the AI impact, or where the AI disruption can maybe potentially impact them a little bit more, I'd say, relative to the SaaS side of things.
Yeah, that makes sense, Angelo. It is such an uncertain environment and such a dynamic environment that there are some companies that are just kind of taking a step back, I think, and assessing what they can and cannot do, and how they're going to deal with all this change. So, in some cases, you're going to probably have big tech projects put on hold. I would imagine, maybe, whereas in the past they would have gone forward. That's actually my old space. I covered IT services 100 years ago when I was on the sell side. So let me go back quickly to the valuation discussion, because it kind of relates to the question about the $1 trillion of spend, and can we really get that annually for the next few years? I'd like to value things based on future peaks and future troughs. And right now, I don't know where the peak is, right?
Yeah.
Maybe it's 2030. And I don't know how deep the trough is after we hit the peak, whenever it is. So how do you think about, this discussion of what's going to happen in 2030 really comes to light when you're talking about the memory names, right? These things have just been moonshots this year before a recent collapse. They're still up nicely, but the moves have been tremendous as the market debates, what 2030 looks like and what 2035 looks like. So anything you could share with our listeners to help think about how to value those types of cyclical businesses?
Yeah. It's memory has always been kind of the most frustrating area of the semiconductor supply chain, and rightfully so. It's because it's the most cyclical and it's got the most earnings volatility among all the different segments of the semi ecosystem. When I think about memory, I think about different phases of the memory cycle, right? So there's you've got these boom and bust. Historically, you've had these boom and bust periods. When you hit a peak, you kind of go through some massive rationalization. Average selling prices start rolling over. As average selling prices roll over, you kind of you start cutting your spending, and after that, what you'll do is you kind of cut some of your capacity because you'll think you have too much of it. That actually happened in 21, 22 into 23, where a lot of these DRAM providers cut as much as 30% of the industry capacity, or took about 30% of industry capacity offline. thinking, hey, we built too much during kind of the COVID environment. And clearly they had gotten to a point where pricing had collapsed. We had these companies were actually unprofitable in nature, very common in prior memory cycles, and gross margins went negative because they had to write down a ton of their investments. But when you think about an upcycle, right? Eventually you find that bottom, that stabilization. The first year is usually the best year, right? It's that recovery year. That's what, as an investor, when you want to first be in it. Then you've got that profitability phase where once you're recovering, you don't necessarily want to aggressively expand capacity because you're getting more profitable. Average selling prices are starting to come back because that supply in the market is getting filled, and that's helping you. So you want to continue to get more profitable because you had lost so much during the downturn. Then the third phase of the upcycle is usually the investment phase. It's when you significantly increase CapEx spend. And that's the phase you're probably at right now. And the question right now is, how long does that investment phase take place? And do we get to an extreme point? What's happened in the past is because these cycles have been more consumer dominated with PCs and smartphones, let's call it over the last 15 years or so, the boom bust cycles, have been the up cycles have not lasted that long. They last about 8 to 12 cycles, and then the downturns will last, let's call it, 2 to 4 quarters, maybe a little bit longer than that. And you just kind of rinse and repeat, right? This is a little bit different because of who the spenders are and what's driving it. So this investment phase right now is, as long as it doesn't get out of hand in terms of the three big players, that being SK, Samsung, and Micron on the DRAM side, don't get out of control in terms of the spend, then we'll be okay. At this point in time, it doesn't look like they're going to get out of control because they're, to an extent, also capacity constrained in terms of the equipment that they can buy and put into these facilities. Not to mention, when you think about the memory that's actually getting built right now, it is high bandwidth memory. It soaks up 3 to 4x the type of capacity that you would use for traditional memory. So, or in traditional use cases on the consumer side. So that helps a lot in all of this. So, this is one of those situations where most of these companies are sold out through 2027. When you look at the purchase commitments of the hyperscalers, we're looking at close to $2 trillion from just 4 companies or so. Yeah, it's pretty insane. So, and that number just continues to go up, and a lot of it is going towards memory. I think what's also important that people need to understand is when these companies came out earlier this year and they blasted out their free cash flow and they put it on the CapEx side, every dollar that goes that went from that free cash flow that was going to be used for buybacks now gets deployed into the supply chain, and that has a huge multiplier effect, right? So if Microsoft is now buying a server, let's call it, a good chunk of that or most of that might go to NVIDIA, but NVIDIA is also then, they've got it. Then there's a multiplier effect below NVIDIA, right? Some of that is now going to your memory guys. It's going toward your networking guys, your CPU vendors or what have you. Then when Micron gets that, whatever portion of that dollar, they've got to spend it on that CapEx dollar. So there's a huge multiplier effect, and that's why the earnings trajectory across the tech ecosystem has absolutely shined this year. It's because of that multiplier effect that we're seeing, and a lot of that multiplier effect is going to continue to take place into 2027, especially as it trickles down across the lower end of the supply chain. So it's really important. But as we look at these cycles and the valuations, at least for memory right now, again, you're trading close to peak multiples. In prior peak cycles for the memory industry, you were looking at about 4 or 5 times. Which is where Micron is at on a forward basis at this point in time. Mid-cycle for us would be closer to 15 times. So if you think this peaks out at, let's call it, a company could, see earnings like, Micron sees it closer to 200 or so, or maybe, mid-cycle, is it theoretical where you kind of get closer to 100 or something like that? I mean, we don't know what that looks like at this point in time, but what I do know is, one, the free cash flow over the next 3 to 5 years is going to be absolutely insane for these companies. 2, I do think in the trough cycles for these companies, I don't think we're going to be talking about, losses anymore. I don't think we're going to talk about the need to raise capital or whether it be through debt or equity for these companies, like they've had to do in the past. So these companies are much better financially positioned to go through boom and bust cycles. And I think, also on top of all of that is, I think the margin trajectory of these companies are going to be significantly higher because of the type of chips that they're now producing. It's very different. It requires, it's not just putting up four walls and pumping out, some basic memory chips. It is a lot more sophisticated and tougher to build this stuff. So it's not like the Chinese are going to come out tomorrow and be able to pump out high bandwidth memory 4 or 5, shortly. They're going to continue to be 3 to 4 years behind us in terms of that side of things. So from that trajectory, I think there's going to be a price discovery phase at some point in time. It may not happen until you get to a downturn, unfortunately. So you may have to sit with these type of valuations, and the upside may be limited in terms of memory, but in the same trajectory, you could potentially see a price discovery moment over the next 18 to 24 months where people realize, hey, the free cash flow potential of these companies, during up cycles as well as potentially down cycles, might look much better than the market is giving it credit for. So I know it's a long-winded answer, but overall, I think you've got to be pretty optimistic given where the valuations are for memory, and the fact that they're already discounting, I think in many respects, peak value earnings.
Yeah, if these things end up being less cyclical than they've been historically, then you have the potential here for higher earnings to move these stock prices quite a bit higher. That's not necessarily something you can have conviction in now,
Yeah.
but
Yeah.
but there's certainly an opportunity there, no doubt. So I agree with your sentiments on that space, Angelo. Thanks so much for that. Tough questions. You really have to look into your crystal ball, but I appreciate a great job with those answers. Really good perspective from somebody who covers tech all day, every day. So I think we'll wrap it up there. But and I also know some of you who are listening are probably at the LPL Focus conference. So for those of you who are out there, hopefully you are having a great conference in San Diego. It's Monday, right around lunchtime here in Boston, as we're recording this on August 10th. So I also want to mention that CFRA is available to all LPL advisors by subscription. So if you're interested in getting all of Angelo's work and the work of his many colleagues, you can do this for help if you need it in finding out how to subscribe to CFRA. So thank you again, Angelo. Appreciate your time. Thanks, everybody, as always, for listening to another edition of LPL Market Signals. We will be back with you next week. Take care.